Mortgage rates are slightly trending down, but only slightly. The Federal Reserve isn't rushing to cut rates to bail anyone out, and nationally, more homes are sitting on the market and price reductions are trending downward compared to this time last year. This doesn't scream crash, but it also doesn't look comfortable. At the same time, the job market hasn't cracked and buyers haven't disappeared. So we're not looking at panic. We're looking at friction, the kind that builds up slowly when affordability stays tight and supply starts to creep higher. In this week's National Data Review, I'm going to walk you through where that friction is forming, how the bond market and the Fed are shaping it, and how it compares to what we just saw here in San Diego last month. And most importantly, what the heck all of this actually means for you. Because when you connect those dots, the picture gets a lot clearer heading into the next few months, and to be frank, it even gives us a good vision of what to expect for the rest of the year. All of that and more is what we're breaking down in this week's San Diego Market Matters, and I'm Karl, your San Diego Realtor. If you haven't subscribed yet, consider doing that now so you can stay current on what's actually happening in this market and not just the headlines. Now, let's get into the data and see where things are really standing. Let's start with big picture economy. The Fed funds rate is currently sitting in a target range of 3.5 to 3.75, which means borrowing money is still relatively expensive compared to where we were a few years ago. The Federal Reserve hasn't cut yet, and that tells us that they're still cautious about inflation. When the Fed holds rates steady like this, it keeps pressure on mortgage rates and affordability. Next, inflation, measured by PCE. It's at 2.9% as of December. That's much lower than the peak we saw a couple years ago, but it's still not fully back to the Fed's ideal 2% target. At the same time, it's been creeping up since April of 2025. So while inflation isn't out of control, it's not completely solved either. That's part of the reason the Fed isn't rushing to lower rates. Then we have unemployment. It's sitting at 4.3%, which is still historically low. In simple terms, most people who want a job still have one. We're not in some iRobot scenario where machines have replaced half of the workforce, at least not yet. And that kind of labor stability matters for housing because you don't get a wave of forced home sales unless people are losing their incomes. GDP, gross domestic product, came in at 1.4% for the fourth quarter. That tells us the economy is still growing, just at a slower pace. So overall, we're not in a recession, but we're also not in a booming environment either. We're in a steady, slower growth phase, and that's the backdrop the housing market is operating in right now. Now let's look at what the market thinks the Fed is going to do next. According to the CME FedWatch tool, there's roughly a 94.6% probability the Fed holds rates steady at the upcoming March meeting. Only about a 5% chance of a cut. In simple terms, investors are betting that nothing changes this next month. Now, here's why this matters for housing. Mortgage rates don't move because the Fed says something. They move based on what investors expect the Fed to do in the future. And those expectations show up in the bond market, particularly the 10-year Treasury yield, which mortgage rates tend to follow. If investors believe that rates were coming quickly, you would likely see the bond yields falling in anticipation. But with a no change probability this high, it tells us investors don't expect immediate relief. And when expectations stay steady like that, mortgage rates tend to stay elevated. Now, even though inflation has cooled from its peak, it hasn't cooled enough for the Fed to pivot. That keeps borrowing costs higher than many buyers would like. And that's part of the friction we're seeing. It's not panic, it's not collapse, it's just affordability pressure that isn't going away yet. Now here's where this gets really, really interesting because what the Fed says and what mortgage rates do aren't always the same thing. Mortgage rates tend to follow the 10-year Treasury yield more closely, and right now that yield is sitting around 4.02%. Over the past couple of months, it's drifted slightly lower, which has helped ease a bit pressure on mortgage rates, but nothing too significant yet. But mortgage rates don't move in sync with the 10-year Treasury. That difference is called the spread, which is basically the extra cushion lenders add for risk and profit. That spread started the year around 2% and has come down slightly to about 1.86. That's a small improvement, but it's not enough to dramatically change affordability yet. Now, when you zoom out, what we're seeing is modest easing, not a major shift. rates aren't spiking, but they're not falling fast enough to unlock demand either. And that keeps the market in this slow pressure phase that we've been talking about. So here's the practical takeaway from this overly technical explanation. The market is slowly adjusting, but it's not getting rescued here. Rates may ease a little here and there, but nothing in this data suggests a dramatic drop that's suddenly gonna make homes affordable again. And when relief doesn't come quickly, that's when pressure starts to build in other parts of the housing market. So where does that pressure start to show up first? It's in demand. And one of the earliest signals we get is mortgage applications. Right now, 2026 is tracking very, very similar to last year, but it's just slightly stronger, which means more buyers are entering the market. And that's important because this time last year, mortgage rates were over 7%. Today, we're in the low 6%. And that improvement is clearly bringing more buyers back into the market. But here's the bigger takeaway. It's not bringing them back in massive waves. Applications are higher, yes, but they're not exploding. And that tells us something important about this environment. 6% mortgage rates are enough to sustain demand, but not enough to unleash it. Buyers are stepping in, but they're being cautious in their process. That steady participation helps support prices, but it does not create the bidding war mania that we think of in 2021. National single-family inventory is sitting at 700,259 homes, up almost 10%. That tells us supply is growing across the country. More homes on the market means more buyers have more options. And when buyers have more options, they gain leverage. At least that's how it's supposed to be. But keep in mind, while inventory is up nationally, so are mortgage applications, which we just talked about, which means there's more buyers entering the market. Now let's quickly touch up on the lock-in effect. For the past couple of years, homeowners with 4% or lower mortgages were reluctant to sell because moving meant giving up a historically low rate for something much higher. That kept supply artificially tight, but as rates have drifted into the low 6% range, that resistance is softening. Sellers are slowly adjusting to the new normal, which is contributing to this gradual inventory growth. And here's where local context matters. In San Diego, we're not seeing that same expansion. In January, detached inventory came down to 2,272 homes. That's down 16.5% year over year. And the attached inventory was 1,799, down 3.1%. So while the national story is that supply is slowly building, San Diego is actually tightening. That contrast is important. National inventory growth creates more buyer leverage broadly, but when local supply moves in a completely opposite direction, pricing pressure can behave very, very differently. This is exactly why national headlines don't always translate directly to what's happening here at home. And this is exactly why next week's local data review matters. National inventory is rising, but San Diego is moving differently. And when supply dynamics diverge like that, pricing behavior can diverge too. So if you want the full breakdown of what this tightening local inventory means for you here at home, make sure you're subscribed and tune in for next week's local data review. Now, back to your regularly scheduled programming. Now let's look at the most honest real-time pressure gauge we have. It's not price headlines, it's price cuts. Right now, the share of US single-family listings with a recent price reduction is sitting around 32%, which means roughly 1 out of every 3 active listings has had to adjust. Now here's the nuance. 32% doesn't mean prices are collapsing. It means sellers are having to align with the market they have, not the market that they remember. When rates stay elevated and buyers have more options, the first thing that changes is seller pricing power, not necessarily closed sales prices. What's interesting is how this year is starting relative to recent history. Price reductions in early 2026 are trending lower than they were the same time in 2025. And remember, mortgage rates are also starting this year lower than they did last year. If reductions follow a path more similar to 2023 rather than in 2025, that could support stronger average price growth nationally as the year unfolds, aka prices will go up. That doesn't guarantee appreciation, but it does tell us something important. The market isn't in free fall. Buyers are negotiating, yes, but they're still transacting, and lower starting rates reduce some of the stress that forced heavier reduction last year. So again, we're not seeing collapse dynamics. We're seeing a market that's sensitive but still functioning and progressing forward. So sellers are adjusting, but is that actually turning into broad price declines across the country? When you zoom out and look at metro level home prices, about 200 of the 300 largest housing markets are still showing positive year-over-year growth. Roughly 100 are negative. That's according to Resi Club's breakdown using Zillow's home value index data. Okay, hold up. About 1/3 of the market is showing negative growth. At the same time, 1/3 of the market is experiencing price reductions. Coincidence? Not at all. This is important to keep in mind and gives us much needed context to the price reduction data. It shows us exactly where or what markets are experiencing price reductions. Now, here's what's important. The number of metros showing negative growth climbed throughout 2025 and peaked around late summer. And guess where else we saw the data peak about that same time? That's right, price reduction data. Since then, negative growth metro data has stabilized and even ticked slightly down. That tells us softness has spread, but it hasn't continued accelerating yet. And yes, San Diego made the negative list at roughly a -2% year over year, but here's where it gets interesting. When I cross-reference that with our local MLS data, the story gets more nuanced. The Zillow reading reflects the entire market combined, but locally, our detached homes are actually still showing positive price growth. It's the attached market, condos, townhomes, apartments, that pulled the overall number down to that -2% year over year. So the headlines say -2%. The deeper story says detached is holding up, attached is softer. That's not collapse, that's segmentation. And segmentation is what you expect in a market that's normalizing with these accelerated rates and limited inventory. It's not unraveling like many buyers are hoping. So the obvious next question is this: if the market isn't unraveling, what are buyers and sellers actually doing right now? Because pricing tells you what's already happened. Activity tells you what's happening in real time, as in right now. Let's start with buyers. Buyer action shows up in pending home sales. Right now, we've got about 321,272 homes under contract. And when you overlay that 2026 on top of 2024 and 2025, the seasonal pattern looks almost identical, except this year it's running slightly ahead of 2025's numbers. Not dramatically higher, but noticeably stronger, and that really matters because mortgage rates have eased into the low 6% range. This is not low enough to make homes feel cheap, but it's low enough to get more people off the sidelines. So while affordability is still stretched, buyers clearly haven't disappeared. They're just more controlled as they're entering the market. And this is important for anyone expecting affordability alone to crash the market. If demand was truly collapsing the market, you'd see it right here in pendings. Instead, contracts are holding steady and they're even improving slightly year over year. Now we have to look at the supply side. New listings nationally are up 7% compared to this time last year. And that tells us more sellers are willing to enter the market as rates have come down. The lock-in effect that I mentioned earlier hasn't vanished, but it is loosening its grip to some degree. And here's something people often forget. Many sellers are also buyers, especially in the single family space. So when listings increase, you typically see pendings increase as well because we have move-up buyers re-entering the system. One metric often feeds the other. So what we're seeing nationally isn't a market freezing, it's a market slowly thawing out. More supply is coming online, demand is responding in the same direction, but neither side is overwhelming the other. That's not a setup for a collapse. That's the setup for balance trying to re-establish itself. So what this should tell you is that more sellers are willing to list as rates come down and more buyers are willing to act, but neither side is going full send. That's why you get this weird mix where inventory can creep higher nationally, price reductions can still stay elevated, and pendings can still hold up at the same time. It's not a crash setup here. It's a pressure system where the balance depends on whether supply keeps building faster than demand or demand keeps absorbing it. So here's what this really all means. The national housing market isn't crashing. I'm sorry, I know you've been waiting for that headline, but it isn't booming either. So there's your balance. It's adjusting. Demand is still there, supply is slowly building, prices are segmenting. That's what a market finding its footing looks like. And when you understand that, you stop reacting to headlines and you start making smarter decisions. Now, if you found value in this breakdown, hit the like button and subscribe so you don't miss the next one. And if you're trying to figure out what this means for you personally, buying, selling, or just planning, reach out. I'm always happy to have a real conversation with you about your situation. As always, I'm Karl, your San Diego realtor. I'll see you in the next video.